Dear students, we will do a new module 43. This is about computation of income from let out house property. This is divided into 4 parts and totally we will be doing 10 problems. So in this module, we will work out 3 problems. So let us go into the details. First problem, from the following particulars, find out the taxable income of Mr. A for the assessment year 25-26. Let out house property was completed on 1/9/2019. Two houses, municipal rental value 12,000 and one that is self-occupied. Second one is let out 24,000. Fair rental value 18,000. Second one it's not available. Actual rent received self-occupied nil, let out 30,000. Municipal taxes 1,200 and 2,400. Ground rent 500 and 2,400. Interest on loan taken for the assessment year 25-26, it's 10,000 for both the flats. Now interest on loan for the assessment year 2018-19 to 2022-23, it's nil. Second flat, it is 15,000 per annum. Fire insurance premium nil and 2,000. Income from other sources 50,000. So the taxable income, meaning we have to calculate the income from house property, then we have to include income from other sources, and then we have to tell the taxable income. You have to read the question properly. Please remember that here it is not the income from house property, it's the taxable income, that is including income from other sources. So first house property is let out and it's self-occupied. That meaning as per the old scheme, 10,000 the interest on loan, that is the only item he will get as loss from income from house property. But if he is following a new scheme, that is also he is not eligible to claim. So the income from self-occupied house property will be nil. Now we have to see the let out house property. One more thing I want to explain. So this is here it is mentioned that pre-construction period interest. House was completed on 1/9/2019. So that meaning 1920 onwards pre-construction period interest started. So that for 5 years. That meaning it's ended with 22-23. So this year it is not available for them. So self-occupied house property, you don't have to self-occupied. You will get loss from self-occupied house property as per the old scheme 10,000. Let out house property, municipal rental value 24,000. Fair rental value is not available. Actual rent received is 30,000. So whichever is higher we will take as the let out house property. Whichever is higher is the gross annual value. That is 30,000. 30,000 less municipal taxes. Municipal taxes you have to remember 2,400. 2,400. Now you will reduce 27,600. That is the net annual value. Net annual value is equal to 27,600. Less deductions under section 24. This standard deduction 30%, 30 by 100 into 27,600. The value is 8,280. 8,280. Interest on loan. This is the value we are adjusting as per the old scheme for the self-occupied house property. New scheme, it is not there. So interest on loan, self-occupied house property 10,000, let out also 10,000. So 18,280. So here income from house property is 9,320. 9,320. So both the values we got. Now we have to calculate the income from taxable income. So taxable income meaning first, as per the old scheme, 10,000 loss is there from the self-occupied house property. Let out house property profit 9,320. Income from other sources 50,000. 50,000. So taxable income for him is 49,320. 49,320. If you are following the new scheme, you have to remember it will be 59,320 as interest on loan for construction of self-occupied house property is not allowed. Now the second problem. Mr. M constructed a building on 30th June 2018. It had 2 flats of equal dimensions and both the flats were given on rent for residential purposes at an annual rent of rupees 12,000 each. He incurred the following expenses for the flats. Compute income from house property for the assessment year 25-26. Municipal taxes at the rate of 10% of municipal value for both the flats, 20,000. Fire insurance premium at 2% of municipal value. Rent collection charges of first flat, 600, it's not allowed. Repairs and alterations, 1,000, not allowed. Interior decoration charges, 2,000, not allowed. Legal charges for the recovery of rent for the first flat, 1,000, not allowed. Interest on loan taken for the second flat, 4,200. Conservation tax for each flat, 150. This we have to allow under standard deduction along with the municipal taxes. Conservation tax meaning each municipality or corporation will be collecting for sewage collection, maintenance of that. So they will be charging that, and it's an allowable expense along with the municipal tax. So here two flats, both the flats are let out. So here you have to remember first flat and second flat. First flat and second flat. So here MRV 10,000 each, actual rent received 12,000 each. So gross annual value meaning the higher value we will take. Gross annual value 12,000 and 12,000. 12,000 and 12,000. Less municipal taxes. Less municipal taxes. It is 1,000 plus 150 conservation tax. 1,150. 1,150. So net annual value is 10,850. 10,850 is the net annual value. 10,850 net annual value is equal to 10,850. Now here both the houses are let out. So less standard deduction. Standard deduction under section 24. So 30% of this value, that is 3,255. 3,255. Here also 3,255. Now, interest on loan taken for the construction of the first flat, it's nil. Second flat, it's 4,200. So when you reduce these values, 7,000. Here it is 7,595. Next is 3,395. So here the computation is asking the income from house property. Add these values together, you will get 10,990. This is the income from let out house property. Now we will do the third problem. That is, Mr. J is the owner of a residential house property which was constructed on 31/10/2016. And it was let out from 1/12/2016 for commercial purposes. Other details are the following. Municipal valuation 1,50,000 per annum. Fair rental value 1,80,000 per annum. Standard rent 15,000 per annum. Standard rent 15,000 per annum. Actual rent 16,000 per month. Municipal taxes 15,000 paid by the tenant. It's not allowed. The total value is 25,000. Paid by the owner only will be allowed. Water and sewage benefit tax due. Due is not allowed. If it's paid only, it's allowed 12,000. Fire insurance payable, not allowed 6,000. Legal charges for recovering rent 15,000, not allowed. Stamp duty and registration charges 30,000, not allowed. The unrealized rent for the year 22-23 amounted to rupees 16,000. But a deduction of rupees 12,000 was claimed. This assessment year, 14,000 were recovered from the defaulting tenant. Then compute the income from house property for the assessment year 25-26. So this unrealized rent also we have to adjust. So here first is let out house property. Second is deemed to be let out. Deemed to be let out, that is unrealized rent. So you have to remember municipal rental value 1,50,000, fair rental value 1,80,000. Standard rent 1,80,000. Actual rent is 1,92,000. So whichever is the higher value we will take. So gross annual value is 1,92,000. 1,92,000. Now less municipal taxes paid by the owner. Less municipal taxes paid by the owner 10,000. So here it is 1,82,000 is the net annual value. 1,82,000. Now less standard deduction. 30% of less standard deduction under section 24. 30% of 1,82,000. That is 54,600. 54,600. Now 1,82,000 minus 54,000. Here it is 1,27,400. 1,27,400. Now unrealized rent recovered earlier as deduction. 14,000 minus 4,000. 16,000 minus 12,000 is 4,000. So the value is, here it is 10,000 unrealized rent. For this also we have to allow standard deduction. Standard deduction under section 24. So here you will get a balance of 7,000. Now you have to remember, income from let out house property 1,27,500 and deemed to be let out, that is the unrealized rent adjustment 7,000. So total income from let out house property is 1,27,400 plus 7,000, 1,34,400. This is what I wanted to explain in this module. Happy learning. Thank you.